got a good session for us ahead. We're going to talk about some interesting elements, but also, we've got an awful lot going on in the markets this week, an awful lot of big news coming down the pipes, and so we want to be ready and aware for that. What should we talk about? As always, we'll have a little chat about Monday Market Matters. What we're going to focus on today, as I said, for our educational element is, why would you want to improve your entries? Okay, well, what's to be gained from it? What are the options for us? Okay, if we want to go through that. And what are the sort of pros and cons of using some of those advanced entries, and how do we use them in our trading? And then, as always, what we'll do is we'll switch across to the live markets and have a little look about how they are setting up, and maybe there might be opportunities there for us to employ some of the sort of education elements we touch upon in our session. So there's lots for us to cover. So stay with us to the end, because as I said, we'll go and have a little look at the live markets and see what's going on in what should be, as I say, a rather interesting week. For those of you who don't know me, my name's Paul, traded for many years, traded for funds, traded for clients. Primarily, I like to focus on trading FX indices and commodities. I tend to be a trend trader for the longer term swing and position trades, and I tend to be a reversal trader for sort of shorter term intraday trading. That's my particular style. So I appreciate that we get a broad range of people who join us for our sessions, and I also recognise that we get a broad global location. Even though these are the English-speaking webinars, and we appreciate that there are people who join us from all over the world. You're all very welcome. Hope you've had a good year in what has been a rather eventful year. And all of us here at ActivTrades hope that you'll enjoy the rest of 2023, and then it'll be a good end of year for you. But Monday Market Matters is our sort of Monday webinar to help us start the week in the right frame as we prepare for the opening of the US market in about 25 minutes time. So every Monday at 2 o'clock London time, what we've been covering is we have a look at the major news that's coming out for the week ahead. Our main element is on the education. As I said, we'll look at improving price action entries. We'll always have a little look at the tools that are available to you as an ActivTrades client. And then we finish off looking at the live market at the start of the US session. So always plenty for us to look at, always plenty for us to talk about. Okay, always plenty for us to get into our particular sessions. So with that in mind, let's have a little chat about the news and the news that we're coming up for the week ahead. So I make no apology, because I say it every week, if you're new to trading, I don't expect you to be able to maybe analyze, in-depth economic policy items, but it is important for you to know when economic news is coming out. And the quickest and easiest way to do that is to use an economic calendar. You will find that there is one on the ActivTrades website you can utilize there. And yes, there are other ones on the internet as well. The important thing is that you know when the big major elements of data are coming out. And this is a week where we've got quite a bit of that data coming out. Okay, so it's probably the kind of last, let's say, sort of chunky week of news data before things tail off as we run towards the sort of end of year and the kind of holiday period associated with that. So let's have a quick look through what we've got. Yes, a little bit of Australian data today, okay, and I think there's a little bit of Australian data tomorrow and elsewhere in the week. But the real main elements that we're going to be looking for this week is that we have central bankers speaking. So tomorrow, interestingly, what we will have is the inflation figures, okay, the US CPI data. So that will be out tomorrow morning in the US, or the afternoon for us here in Europe, and people will be interested to see if that basically maintains Mr. Powell's narrative, based upon the fact that on Friday we had the non-farm payrolls. Those job numbers actually beat expectation, and there's an indication there that still the economy still remains as strong and is adding jobs, okay, which is kind of different from people thinking that Mr. Powell and his interest rates are his interest rate rises are probably have peaked and probably will likely to be tailed off. And that's actually, whilst we have other data coming out, so German ZEW economic sentiment indexes, okay, from Germany in particular are useful, and you see the sentiment index from Japan and business confidence in Australia. Tuesday, definitely the US CPI data is really where we'll we'll be looking at. And close to home in the UK, first thing in the morning, we have the sort of the climate change numbers as well. But Wednesday, what we do have is we've got UK GDP data and US PPI figures, okay, but really everyone will be looking at the first of the real kind of, let's say, central bank monetary policy meetings, and that's what we've got Wednesday evening with FOMC. We have FOMC on Wednesday. And then on Thursday, we have the Swiss National Bank. Okay, they have their policy meeting. We have in the UK, okay, the sort of the Bank of England policy meeting, and we also have the ECB, the European Central Bank. They have their policy meeting as well as you can see US retail sales. Well, I think those you've got, there's four central banks speaking, and whilst the consensus is that there's unlikely to be any real major changes made this week. People will still be interested to see if there is a curveball that is thrown, that there is a change, or more importantly, looking to see what is the narrative, what is the sentiment, okay, around the statements and the press conferences that are associated with these central banks. Will they be able to detect a change in that? Because I think that is what people will be interested in, as we get ready to exit 2023 and prepare for what I suspect is going to be a rather interesting and eventful year of 2024. So that is going to be the main elements there. And on Friday of this week, what we also have, yes, we do have Chinese data, but we also get an awful lot of the flash manufacturing and services PMI data for Japan, France, Germany, EU, the UK, and the US. So there's a lot of data on Friday there. So there is a lot of data, coming down the pipe this week. Again, I think it'll probably be really the kind of major, week of data, and then you will probably find that things will quieten off significantly as we run towards the end of the year. So, as I say, if you're a new trader, I don't expect you to be able to completely understand or analyze the data, but it is crucially important that you know when that data is coming out, because the input of that new data, right, that's what can sort of bring in volatility into the market, and you want to be able to sort of sidestep that, as a new particular trader. So, awful lot going on there, awful lot for us to be aware of, and make sure that you're covered off as we go forward. Excuse me. So, as always, we do the news, and then we have a look at our element, educational element. And this week, we want to talk about improving your trade entries. That's what we're particularly looking for. And as the slide says there, completely new traders, they're generally happy to just find any entry for their trade. Okay, any entry is better than no entry for a new trader who's looking to engage with markets and increase their skills and see how they develop. And that's all well and good to begin with, ladies and gentlemen. However, as a trader, as you develop in your experience, okay, and your knowledge, well then, important good traders are looking for ways to improve the way they go about business, to look at how to improve their trade entries, because by improving those trade entries, well then, you can help sort of, let's say, nudge the KPIs in your favor, your key performance indicators. So what we'll do today is I'm going to discuss a little bit of an improved entry that traders can take away and use in their trading, okay, and in particular things like price action reversal candlesticks. Now, every candlestick is a reversal, signal really. That's the nature of the beast. But what I'll do is I'll take away and share with you like an important little element that might actually help you improve your trade entries. Which we'll discuss, why that is important. So the important thing we're looking for is, well, okay, why would traders want to improve their entry? Surely if you have an entry, well, then that's good enough, isn't it? What more do you need to improve your entry for? What is the payoff? Well, in the initial element, it is all to do with managing your risk to reward ratio, okay? You'll hear some traders call it R3. By improving our entries, we are able to improve our three numbers, our risk to reward ratio, and in doing so, that can have an impact on our overall positive expectancy. In many ways, it might be what creates positive expectancy for us if we have been struggling beforehand, and we'll look at that in a little bit more details at the moment. It'd be interesting to know, the people joining us here today in our session, how many of you, have improved your trade entries based upon, how you started off trading. Are there any particular hacks or particular tips or things that you have learned and that you have utilized yourself in your own trading that that have helped you develop as a trader? It'd be interesting to know what your own experience has been. So, for the new traders in the room, let's start with understanding trade risk. Okay, so just so you'll understand here what I mean. Okay, when I talk about trade risk. So, when I talk about trade risk, that is a term that determines the number of. It might be pips in an FX market. It might be points, okay, in something else. It might be ticks, okay, in equities or indices, etc. And it is. Let's bring up the old drawing tool. It is, it is the number of those when I look at trade risk between my entry and where I'm positioning my stop loss. Okay. Now, and what I have identified my trade risk, excuse me, well, then that is always defined as 1 unit of risk, or you'll hear me talk about, that is what's quite often is known as R. And as traders, we look to trade and we look to earn multiples of R. Excuse me. So, if, and it doesn't really matter, it doesn't really matter whether you're trading monthly charts, daily, 4-hourly, 1 hour, 1 minute charts. Trade risk is always identified as being, let's call it, I'm going to call it just number of points, okay, just for the simplicity of conversation, the number of points between our entry and our stop loss, okay. So on if this is a weekly chart, it might well be the number of points could be, maybe it might be 500 points, okay. If this is a 1 minute chart, it might actually only be 50 points. It might actually for a 1 minute chart, it might actually only even be 5. It might actually only be 5 points. Excuse my terrible artistry there. Whether it's 550 or 5, okay, that trade risk. Once we've identified it, we will identify that as, I will talk about that as a unit of risk, okay? 1 unit of risk, 1 R, all right? And as I said, as traders, I'm always looking to earn or create multiples of R. So if I'm risking 1 R, I preferably want to be in traders that generate 2R, 3R, 4R, 5R. And whilst it's not the purpose of today's session, one added benefit of talking about it in terms of units of risk is that it starts to remove the emotion of it. So if people talk about in the kind of risk in terms of pips, or as more often maybe in their financial risk, how many pounds or dollars or euros or whatever that they are risking, that can become quite emotional, right? Whereas actually when you're just talking about it as a unit of risk, that makes a big difference. Okay, it takes some of the emotion out of the whole situation, and for many traders, that can be what helps them in the way they operate, and makes it a little bit clearer and easier to engage with markets. So it is important that we understand trade risk, and certainly in terms of the way I define it, because by doing so, it allows us to identify ways to improve our trade entries to reduce our trade risk, okay? Because if I can reduce my trade risk, well, then what it happens to do is it helps me improve my overall reward to risk numbers, my overall R3 numbers, okay? So how could we do that? Is there a simple way that I could basically improve my trade entry in a mechanical way? And a way that I do it is to do a thing what you'll hear me talk about, I call consistent targeting, okay? And that's the way I look to do it in terms of ways to improve my trade entries, to improve my overall reward to risk ratios. And I'll share that with you now. So, in previous webinars, I've talked about, in terms of managing risk, you also have to, on the flip side of that, manage reward, okay, in terms of what are your exits? And so most people will either have a trailing stop on their trade, or they will have a target that they aim for. And I always say neither one is perfect. It's about which one can you consistently do on every one of your trades. So, I'm an ex-Air Force guy. All right, Air Force guys, we like to hit the target. All right, it's what we live and die for. So, I find it easier for me to use targets in trading. Okay, when I'm into a trade. Some people will disagree, and some people might say, "Well, Paul, you might be better, or I prefer to use a trailing stop." And that's absolutely fine. That's what makes a market, okay? That's absolutely fine. It's not about searching for perfection. It's about what can I consistently do, trade after trade after trade after trade. That is what I'm aiming for. That's the important thing. So what I'll do is I'll share my own tools that I use to help me find simple, consistent targets. And in doing so, improve my entry and increase my overall reward to risk on my trades. And I think there's a couple of examples at the end as well that we can touch upon and cover, which hopefully will give you a little bit of insight on how you can utilize. So this is where to help me with consistent target, this is where I will use. This is where I actually only really will use Fibonacci and the tools of MT4, MT5, but also any ActivTrader, TradingView, you can set this up on, okay? And what it allows me to do is it allows me to identify my target and also set an aggressive, improved entry. And this is where I am using a pullback within my trigger candlestick to enact an entry that provides an improved reward to risk. Okay, so I appreciate if you've been trading for a while, that you may pick up on that. If you're completely new to trading, that might shoot over your head a little bit. That's okay. Don't worry. That's what we're here for. We will go through this and explain. I'll explain it further over the next few slides. So, excuse me. This is a tool. I'm not really going to talk through this. This is a page you might just want to take a screenshot if you're using MT5, if you're using MT4, or even TradingView or ActivTrader platform. Okay, just take a screenshot of this particular page because it refers to basically MT4 and MT5 as a little tool, and what it does here is if you work your way through this particular procedure, what you will be able to do is you'll be able to upgrade the Fibonacci tool on MT5 and MT4, and maybe what you can see there is it actually allows you to basically identify the specific Fibonacci levels you particularly want, but also what it will do is it will basically it'll also chart exactly what those particular levels are, which especially if you're intraday trading, that can be enormously helpful because you're under a little bit of time pressure. So to know when you basically string your Fibonacci tool across a candlestick, it will immediately tell you, where my pullback level is, because I like about a 30% pullback level, and also, where my particular targets are, okay, and what those levels are in case I need to quickly put them onto the platform. So, as I said, you can take a screenshot of that if you're using MT5 or MT4, that will help you. But ultimately, even if you're using ActivTrader or TradingView, being able to just update your Fibonacci tool, okay, it will help you in terms of what I'm going to discuss over the next few slides. So how do I use it? How do I use consistent targeting to help me? Firstly, as always, is for my stop loss. Identify my stop loss because my risk management always comes first. So for me, I always use the standard level to place my stop loss at. Okay, why? And mainly it's because I'm a momentum trader. I expect momentum to carry on without a really very strong snapback. So let's just say this as an example. Let's just say that we have been in a trend. Price pulls back. Price prints this bearish engulfing candle, and I'm ready to basically to be short of there. So my stop, okay, if I'm looking to trade this engulfing candle as my trigger, well then my stop is always looking to be above the high of that candle, okay, if I'm looking to be short. And how far it is above will depend on a couple of things, but as a general rule, when I'm going short, as a general rule, I would say 2 pips plus the spread. Okay, so some things like euro dollar there might be a 1 pip spread. some things like, pound Swiss, could be 5 pips, 10 pips, okay, depending upon the volatility. So just be aware of that if you're going short. But in terms of a stop loss, I will never trade without a stop loss. My stop loss always goes, okay, when I'm using a candlestick, it always goes at the other side of the candlestick, okay, a couple of pips above in a short or below if I'm going to be a buyer as part of the way I would look to trade. Second element is, well, I use for targeting. Okay, that's what it is. So, and this is why, and this the clues in the name, consistent targeting, because what I'm looking for is that my first target on the trade is the 261 fib expansion, okay, of the range of the candle, okay, and my second target is the 423, okay, the 423 fib extension. So, and that's what I'm looking for in terms of my target, but I am also taking notice of the kind of, in this case, relevant support levels in front of me. Okay, I want to be aware of that. I want to have the situational awareness of what's going on around me. But what I'm looking for is the 261 fib extension, okay, as my target, first target, and 423 as the second target, okay. And hopefully, maybe even you can already see is that if I have a range here, okay, well then that target then that starts to help me improve my reward to risk. It helps to improve, okay, those KPIs, that R3 number, which I'm always looking to at ways to try and improve. So, what I am particularly looking for here is that the reason I'll use is that the 261, okay, is what I use for my intraday trades, my short sharp intraday trades. Okay, that's what I tend to use as my target on intraday trading. And what it means is that if I have a standard stop loss, and here's where I start to help myself, is instead of having an entry just beneath the break of the low, I have my entry here back inside the candle. The price pulls back before it moves down, okay? And so when I do that, when I basically utilize the third of the pullback away, okay, into my candle, what happens is that my reward to risk on winning trades, okay, from entering in the third, when I stop above the high, when my target at the 261, well, my reward to risk can be anywhere between about 1.8 to 2.3 R per trade. Depends what I'm trading, okay, depends on the timeline, the spreads, etc. But as a rule of thumb, okay, it allows me to achieve about a 1.8 to 2.3 R. Sometimes it might be a little bit less, depending upon spreads. Sometimes it might be a little bit more, but it's in that window generally, okay? It's in that window. And for me, as intraday trading, I'm absolutely very happy with that. That is, that's asymmetric reward to risk. So automatically, I am generating asymmetric reward to risk. If I'm risking 1R to make on average 2R, that's Paul as a happy trader, because that's what I want to be doing. That is how I want to be operating as a trader in the way I look to operate. Alternatively, depending upon if depending on the time scale, and also if I'm trading with the trend, okay, well then I might be looking at the 423, okay, the 423 fib extension. And the thing about the 423 is it gives you a fantastic reward to risk ratio. So using my standard stop loss place and my third of a pullback entry, okay, improve my entry by using a third of the pullback from the candle, well then I can average somewhere between 3.2 to 5.5 R per trade, okay, and I said that range that's quite it's a wider range because of the sort of the distance we're trading. Also, as I said, the kind of the timeline, okay, and sort of the time scale you're trading, and also the spread, that can all have a difference. So it might be less on, let's say, on a 1 minute chart, and it could be more on, let's say, a daily chart, okay, because the spread is going to be a smaller part of the overall trade sizing. So that is how we can do it, okay. But you have to recognize is that everybody naturally loves to see that the 423 fib extension giving you a fabulous reward to risk. But you have to also realize that with that, with increased reward, there is also greater risk, and the greater risk is that of course, it doesn't make that, because invariably price needs to go in your direction for longer and further. Okay, so there is always a let's say a sweet spot. Okay, that we are looking to achieve in terms of what is possible and what is probable, and how we can work with that. So that is how I use the fib tools, okay, to give me a little bit of an improved entry, and also to give me a consistent target based around fib extensions. Now, the next element of that is, of course, about utilizing that with, price action reversal patterns. And so a lot of what I utilize in the trades is what a lot of I share. So sometimes people forget that by their very nature, candlesticks are a reversal pattern. So the important thing you need to remember is that there needs to be something to reverse beforehand. There needs to be a little bit of a retrace or a trend, etc., that will give you that opportunity. But in terms of popular candlesticks, which we've touched on many times here during these sessions, it is things like rejection candles, okay, pin bars, or engulfing candles, okay, which is what we've looked at previously as well. Key reversal candles here, okay, like these guys here, or morning and evening star formations like those there, okay. So there are lots of different, reversal patterns. Today we'll focus on like pin bars and engulfing candles, just because of the nature of the time and stuff, and also we do. But the concepts are applicable elsewhere. Okay, I'm just sharing the most popular with you today. Okay, sharing the insight and the most popular ones today. So, regardless of what I'm sharing about having improving your entry by having a bit of a pullback and having a further target based on fib extension, regardless of what I'm sharing with that, it does not escape good trade selection. Okay, you're doing your analysis, understanding the context, understanding the pattern, and understanding the trigger. These are all important together. Okay, you can't just basically string your fibs over any candle and expect it to play out. What we want to do, as I said, is still good trade selection. Okay, and experienced traders know that it's when you trade these patterns that makes the difference. It becomes all about the context. It becomes, and you hear me talking about it all the time, about the confluence of events, okay, where you've got 2, 3, 4 things coming together at one time and place that gives you an opportunity, and it helps you, to take a good trade anyway, and improving your entry. It merely helps you improve your reward to risk ratio. Okay, by having a pullback into that price action as your entry, that is what will help you improve your reward to risk ratio. So, I talk about it all the time, about that confluence of events, right? So ideally, when we're talking about a confluence of events, what we're looking for, if we want to see these reversal candle patterns on a pullback, at a level of support resistance, in an existing trend, okay. And as I said, when I've got 2 to 4 elements coming together in one time and place, that is when you have a higher probability of success. And there is an element of that's why there could be, an element of subjectivity in such trading methods, because, not every trade setup will look exactly the same, because when you're looking for confluence of events, as I said, could be on a pullback, at a level of support resistance, in a trend, those good candle patterns, maybe there's a price action combination in there as well. Okay, all of these things come together, and so each one looks different. Okay, and that means there's that element of subjectivity. Okay, some traders love that, other traders hate that. Okay, but it's that's part of having methods that are able to adapt to the changes in markets, because markets change. Okay, the markets never ever stay the same. They're always changing, and your ability to adapt to what the market is telling you is a key thing as a good long-term sustainably successful trader. So let's have a look at what we mean by pin bar. So we've talked about pin bars plenty of times. Okay, pin bar or rejection candle. Normally, you have the open and the close is within the range of the previous bar. That's what we like to see. The candle wick should ideally be 2 to 3 times the length of the body, and we'd expect to see a long nose protruding from all the other bars. Okay, good pin bars, as it says there, they stick out and are very obvious, and lots of people will use them. Okay, but once again, it's about the confluence. In this particular case, there we've had a pullback at a level of dynamic support of the 200 period moving average, and then we printed a very nice pin bar before price rallied its way up. Okay, it's that confluence of events. All right, 2, 3, 4 things together, coming together at one time and place. Now, normally, okay, the standard entry, and let me tell you, there's nothing wrong with the standard entry, nothing wrong with it whatsoever. But standard entry, okay, is, if you've identified like this, uptrend, pullback, hit support, pin bar, okay, confluence events, you would normally be looking to have your entry would be, a break of the pin bar with your stop loss beneath the low of the candle, okay? And so that's the safest entry and stop loss method, but, you require a very strong move to ensure a good return on your risk. And that's what I would talk about in terms of a good and symmetric reward to your risk. And that's, as I said, that's the standard entry, and there's absolutely nothing wrong with that, okay? There is nothing wrong with trading that way. If we look at an improved entry, okay, well, the improved entry, as I said earlier, is, once I've identified the pin bar, or my entry, I would entry on about a third of the way, a pullback into the pin bar, okay? So I'm entering here instead of here, okay? My stop loss is still in the same place, beneath the low, all right? Nothing wrong with that. But what this does now is basically what that starts to do is that starts to change the trade risk, okay? So, I don't know, maybe up here, okay, to here, maybe there was, 100 pips. Okay, my trade risk is 100 pips on an FX trade. When I'm entering here, well, suddenly my trade risk is 70 pips. Okay, so that makes a difference. Okay, in terms of how the trade looks to run and to play out for itself. Another version of it is on an engulfing candle. Okay, we've talked a lot about engulfing candles. Okay, high engulfing candles where the high and the low of the bar, basically engulf the range of the preceding bar. They are much less frequent than pin bars, but I would suggest they are more powerful than the pin bar. But as I said, they're less frequent. And at the end of a trend, they can signal a significant change in trend of sentiment. So they don't happen as often as you'd like, but when they do happen, especially in the higher time frames, you want to take a notice of them. So if we look at, in the same way we looked at the standard entry for a pin bar, standard entry for an engulfing candle outside bar is that you would know in this particular case where, price is pushed up, we've printed an engulfing candle here, you enter on the break of the low of the candle on a bearish engulfing candle, and your stop loss would be, above the highs. As we said before, just a couple of pips plus the spread on a short trade. And normally that is the safe standard entry, and normally most people are going to be looking for about a 1-to-1 reward to risk. Okay, and there are lots of people who happily trade 1-to-1 reward to risk trade setups, and that's absolutely fine so long as you have a good hit rate. Okay, above, I would suggest, well, anything above 51% is profitable. But I would suggest if you're only 1-to-1, you actually probably need to be sort of 55, 60, 65, etc. That is what gives you a bit of a buffer, but that is where lots of people trade, and that's perfectly acceptable. Okay, it's about finding the way that works for you. If we look at the improved entry, though, if you look at the improved entry, what we're looking for now is we're actually, once we've identified it, we withdraw basically our, run our fib tool across it, identify where the sort of a third of the pullback of the way, okay, back into the candle. That is where our entry would be. Stop loss in the same place as always, and now we'd be targeting the 261, which might be down here, okay, and now we're suddenly having gone from like 1-to-1. We're now looking at perhaps maybe what could be, as I say, anywhere between like 1.5 to 1.8, even maybe up to 2, depending upon the size of the engulfing candle and the sort of the time scale that you're trading. But that improved entry, it starts to change the reward to risk ratio for you. Okay, and that, as I said, that's the sort of thing that can have a big impact on your overall expectancy levels. So here's a couple of examples here. Just 1 second. So what have I got here? This is on gold. The daily chart price is in a nice uptrend, and then what happened here? We were at a level of resistance at the end of a trend, and price printed this bearish engulfing candle. So if I was using the standard entry, let's just clear these down a little bit. If I was using the standard entry, okay, my standard entry was at $18.99 with my stop loss above the high at $19.61. So my trade risk, okay, the difference between my entry and my stop loss, $62, and my target, okay, was down at 1838 for a 1-to-1 reward risk. So it would have been around about here, okay, and it would have hit there, okay, and very nicely on 1-to-1, okay. Whereas if we were to trade that using the improved entry, my entry would have now been, instead of 18.99, my entry would have been at 19.20, a third of the way back into it. We can see that basically the next day it trades up to that level, and my stop loss is still at the same place, but my trade risk is now $41 as opposed to $62. Furthermore, I'm using the 261 target here, okay, which was at 1807, so I'm just a little bit in front of the number. And actually what that did is that generated, in this particular instance, that generated plus 2.7R. Okay, so I'm just showing that the same trade, different setups could provide very different changes in the reward to risk, okay, of that trade. Now, in this particular case, you can see that actually, almost what's that, about 6 weeks later, it did actually hit the 423. Okay, so you can do your own sums off that, okay, if you wish. But as I said, the thing about the 423 is that it can take much longer to achieve this, so it depends upon your overall timeline. But we're just working on even just swapping, 1-to-1 standard entries, okay, for the improved entry with the pullback entry and the 261 target. You can see that the sort of reward to risk is very, very different for pretty much the same trade to be sort of shorting gold off the pin bar, and hopefully you can see the big difference that can actually make to helping you nudge your way to being more profitable. A couple of examples here. Okay, so this now is the dollar yen on the 4-hour chart. You can see price has been in a downtrend. It pulls back, and then it basically prints another bearish pin bar to sort of to have this acting almost like a flag pattern, expecting a continuation of the trend. On my standard entry, okay, my entry would be at 108.60. Okay, just a few pips beneath the low of the candle. My stop, okay, a few pips above the high, the 108.90, so 108.90. So my trade risk, okay, my trade risk in that case is 30 pips, and my target is the big round number at 108, okay, and that's giving me a 2-to-1 reward to risk there, okay. And lots of people will be very, very happy with that trade setup itself. Whereas here, what we have is, we've got the entry now of the third of the way pullback. Okay, so it's the third of the way pullback is at 108.72. Stop loss is still at the same place. So now instead of 30 pips risk, I've only got 18 pips risk. And actually now, because I'm joining the existing trend, well, in this particular case, my reward to risk ratio, or rather, is my target is based off the 423. Okay, the 423 target. Okay, which was the big round number at 108. So now instead of a 2-to-1 trade off the standard entry, now that generates for me a 4-to-1 reward to risk. Okay, so it's the same trade, same setup. Okay, but what it is we're just improving our entries, just changing our entries a little bit, and by doing so, that is what actually helps us to start to sort of improve our reward to risk ratio. And by doing that, well, then basically we're also in a position to, as I said, to sort of increase or help us generate positive expectancy. Might be a bit closer. Another example here, pound against dollar on the 4-hour chart. What we have is, the price had been in a downtrend, and then that downtrend was ended by what was basically a double bottom, finished with a really big bullish engulfing candle. It's also a bullish key reversal candle as well. But, it's a big candle. But if we have our standard entry, standard entry would be 137.50, just above the the highs of the candle. Stop loss beneath the low, the candle at 136.65. So our trade risk, different to your entry and stop, is at 85 pips. And actually, what we look to do is we target the big round number at 140, and that generates a 2.9 sort of R3, okay, 3R, okay, that which in itself is a very healthy reward to risk, okay, very healthy reward to risk indeed. But with our improved entry, well, what we're looking at is our entry now is at 37.20, okay. It's a third of the way pullback, okay, a third of the way pullback into the overall big engulfing candle. Stop loss is still in the same place at 136.65, but our trade risk is now 55 pips, okay. It's now 55 pips instead of 85 pips, and the target we use is the 423, okay, 423 fib extension target, which was at 139.91. And what that generates is a 4.9, just under 5R reward to risk for our trade. Okay, so don't get me wrong, this is a very healthy, 2.9 reward to risk is a very healthy, reward to risk. Okay, but for the same trade, for running the kind of the same setup, there was also the await opportunity to sort of generate a 5 or just under 5, a sliver under 5 reward to risk. Okay, so I'm hoping you can see that actually once you're able to encompass the kind of the 30% pullback and then looking for 261 and 423 consistent targets, well then that allows you the opportunity to sort of just you're improving your entries, but you're also improving your overall reward to risk, and that's what we like to see with our trades, isn't it? So a few final points here before we switch across to the live charts. As always, remember there's no such thing as perfection, okay? One of the downsides, okay, of using let's say the third pullback, okay, 30% pullback into the candle, is that sometimes a trend or a move is so strong that it would never pull back that third of the way into the candle, okay? That happens to everybody. Welcome to trading. If it's not going to do that, well, then you have to just adapt and use a different tactic to get on board that strong trend. But here's a little bit of homework for you. I like to try and set you a little bit of homework to take away and work with. Go back through your winning trades, ladies and gentlemen, and work out how much additional alpha you could have created if you'd used the improved entry and the sort of the consistent targeting, 261 or 423 targeting. Just have a look at some of the trades you've taken. Okay, was it possible for you to A, get the improved entry, and B, achieve a better reward to risk? And could that help you in terms of generating positive expectancy going forward in your own trading? So go away, take away the homework. Just look at a few of your trades. You might be surprised, ladies and gentlemen. Okay, you might be it might unlock something for you to be able to have a little look at. So, conclusions, okay. Money Market Matters has run pretty much all the way through 2023, and I said at the start of it, it's going to be an interesting year in markets, and it has been. I would say it really has been an interesting year in markets, and I really appreciate having you here to join us for this journey through the year. So, when it comes to conclusions from today's session, it's important for traders to understand trade risk, okay, and its relationship with risk to reward ratios. And by doing so, then we're in a position to explore ways to improve our reward to risk ratio. One way of doing that is by improving our entries, and in particular, you do that using a pullback of a third of the way into your trigger candle, okay, if you're using price action candlesticks. What that does is that helps nudge the reward to risk ratio into more favorable territory for you, which is what can make a difference to your equity curve over time. However, it still requires good trade selection, okay? It doesn't mean that you can just literally sort of lump on a position, hit left, right, and center. It still requires you to do your analysis, identify good trade setups, okay? But once you've done that, you're in a position to utilize that information better going forward. So with that in mind, why don't we have a little look at the live market, see how they've set up. The US market's been open for about 16 minutes or so. So let's have a little look and see how they have been showing up and shaping. So we can do that. But before Before we go, just a reminder that next week, Monday Market Matters, I think, is the last one of 2023. So I hope you will join us for that. We're going to talk about building a trading plan for 2024. Okay, so that's what we will focus on. Give you some time to take away for the last couple of weeks of the year and work away improving your trading plan for 2024. So I hope you'll join me for that. If you're not already registered, just use your mobile to take that QR code there, okay, and that'll take you towards being able to sign up for the event and work. And I look forward to seeing you there with me. As always, before we just switch across to the charts, okay, if you've got any questions or comments or feedback, then it'd be great. Okay, you can contact English desk there, 0207 6500 567. If you want to see more of these sessions, next year, okay, and stuff, then by all means, let the English desk at ActivTrades.com if they've helped you in your own trading. By all means, we always look to see the feedback. Please, please feel free to drop them an email there, English desk at ActivTrades.com, and let us know what you think. So if you'll bear with me for a minute, what we're going to do is we're going to switch across to the platforms and have a look at what's going on. So just as I said, just bear with me a moment, and we'll switch to the charts. Okay. Chan says, "Yeah, it was an awesome session." Thank you, Chan. That's very kind of you. Very good. Okay, so here we are at the US indices. The American markets have opened. Let's just have a quick look from the sort of the top upwards. Let's start with the Dow, shall we? Okay, let's have a quick look here. If we go into the weekly chart, you can see here for their weekly chart. I'm just going to draw this in. This is the monthly chart. Okay, I'm just going to literally. That was the kind of high we saw at the end of 2021 and start 2022, and we have, if I go into the weekly chart, we have the last couple of weeks we've broken the high of this year, which I'm going to just draw in there. We've broken the high of this year. We came back and tested it, and the daily chart, as you can see, it came back, tested it, and then actually Friday, we put in there a bullish engulfing candle, okay, bullish key reversal candle. We pulled back, we went to new low, fired up. So that was very bullish after the non-farm payrolls, and you can see really for about the last 5 weeks, having seen those lows around the end of October, we absolutely have just really rocketed our way up there. Absolutely flown our way up there. And so now we're looking at, as we start today, what are we looking for? So if you look at the 30 minutes charts there, okay, is where I like to start, because I want to identify not only the previous days, highs and lows, but all of the previous sessions and going through Europe, etc. What have they been doing? We can see that basically, we've already on the sort of the open of the US session, we're kind of busted out there, okay, to as high as. Let's have a look at that 5-minute chart. Yeah, you can see we barreled all the way up, really barreled the way up, and reversed the way down off that. Okay, the 1-minute chart. Yeah, that's to me that's nice, because we've basically we opened up, we rallied our way up to yesterday's high, the previous week's high, and then to me that is a push. That is a double top there. Okay, a double top there, and a double top that also has the second leg is a bearish engulfing candle. Now, I normally sort of suggest to people that we wait for you wait for 10-15 minutes to basically do that. But what I'd have been looking at if I'd have been trading this, once I'd seen my my second leg here, okay, that's what I'd have been doing. There is just basically. You don't have much time on a 1-minute chart, so you need to know what you're doing. But as soon as I've seen that double top on the second leg with this engulfing candle, let me just check the low, the previous candle 37, and our close was 36. So yeah, we've pushed to a new high, rolled over, fallen away, closed beneath the low. That is a key reversal candle. So you can see for yourself what I've been looking to do is basically, my entry would have been at 36,343 there. Okay, a third of the way back into that candle, 3643. Okay, what is the highs of 58? But remember what we're looking at here, okay, in the Dow. So we've got about 4 or 5 pip tick spread here, okay, because we're at the start of the session. So I would have been looking at that 2 pips plus the 5. So I'd have been my stop would have been at 65, 2 pips plus 5, I'd say, up at 65. My entry's at 43 to 65. Okay, so 22 ticks of trade risk. And then would have hit my 261 target. 261 targets at 298. There. So effectively we have what's that? 45. So 45 points of profit. 45 points of profit for, what was it, 22. 45 points of profit for 22. Okay, so just, even just working that out in your head, that's over 2 pips there, over 2-to-1 reward to risk and stuff. That's what you'd be looking at there, and that's just very quickly. So it's just over 2. All right, just over 2 rewards to risk for the start of your trading session. But hopefully you can see that just even being able to identify that, my reversal is the engulfing candle, my third pull my fib tool over it, look at the third of the way pullback, stop above the high, that's normal. 261 intraday target, bosh. Now it has gone a little bit further, but you don't know that. All right, that's always easy in hindsight to say, oh, it went further. That was your target, bosh. We went there, okay, 2-to-1 target. That's your start of your trading week. That would do you, ladies and gentlemen. All right, that wouldn't be a bad start to your week at all. And you can see, that was on the 15-minute chart. What's what we did? We pushed up to those previous highs, okay, and then fell away from it. That's perfect trading. That's what we're looking for. If I look at Nasdaq, so Nasdaq has been here. I just need to update these charts a little bit. So that had been the previous high of the year. Now, this is now the previous high, and you can see for yourself, we've got up there and we've gone a bit sideways. Daily chart, I thought we might roll off, but you can see that it looked like it was going to roll, okay, but it hasn't. The Thursday, Friday being strong days, and there's no surprise. 30-minute chart, what I remember what I was saying is I kind of like to see where have been the kind of highs of in their case the European session. All right, also the lows. Okay, not been the kind of lows of the day so far, but you can see already, we've blasted our way through previous days, previous weeks highs. Okay, and that's the Friday. But look at that on a smaller time frame. Yeah, that's nice. Whereas you can see, whereas the Dow we looked at gave us a really nice double top, and that, if you look at the price action there, that's not giving us that there. Okay, on the Nasdaq, isn't the Nasdaq's wanting to push its way higher. Okay, it's pushing higher. The kind of swing lows are getting higher as well and stuff. So it's that's got a little bit of a way to go. And as I always say, I like to see the indices working together. So when I see them kind of doing separate things, so Nasdaq's pushing higher, Dow's reversed and rolled over, I'm always starting to get a little bit wary. Let's have a little look at the S&P 500. So we'd seen Dow and Nasdaq had pushed to highs. The S&P has not as yet. If I look at the daily chart, okay, it's kind of just been in a bit of a block, but Thursday, Friday, it did push its way a little bit higher there. If I look at the 30-minute charts there, just looking at where's the lows of the session so far. We've got the highs of the session. There's also Friday's highs and stuff as well. So I'll be interested to see that, what we have done, 15-minute, 5-minute chart, 1-minute chart. So you can see the difference in the price action between the S&P 500 and the Dow and the Nasdaq. It's the price action, especially the 1-minute chart, it's not as pretty, as clean as the Dow and the Nasdaq. You can make some of that for yourself, but yeah, you can see that has just been in 45.99 to 45.9 to 46.08. So you're in a 9 handle. We've been in a bit of a 9 handle range. Okay, you remember what I was saying is that I just put these into, if I just put this in thing, I prefer to see all of them operating in a correlated manner. But Dow was pushed up and now fallen over. Nasdaq was pushing up. S&P 500 was just going sideways, really, wasn't it? It looks like they're about. It looks like there's probably a bit of a sell-off running into the last 5 minutes of this hour. Dow might be kind of leading the way. It's pushed the way up highest and it's fallen down there. Let's just carry on and look at this, see how it plays out. With this trader, actually, I don't think it's gone as far as it's 423. No, oh, there you go. It's not far from the 423. If you're, depending upon your risk profile, okay, you might have gone for the 423 target instead of the 261. Invariably, that provides very, very good reward to risk. But the challenge you have is that you're going to be in that market longer, and that depends upon your own particular risk parameters there. So, what I'd be doing is effectively is I'll just be watching. I think if I look at that there, okay, it looks like maybe the Dow is leading us lower. Certainly the Russells are not looking. Certainly the Russells are not looking very happy there. But I tend to use the Russell as a bit more of a barometer than an actual trading trading tool. As I said, I like to see when they're all operating together in unison. Okay, when they're all correlated, that normally tells me that the algos are happy and they're working it. When there's a little bit of disjointedness, a little bit of divergence, I tend to be a little bit more nervous in my trading style. Right, so that's what's playing out there. Let's have a very quick look at dollar, and then we'll finish up for the day. Let's bring that up and have a look. Okay, dollar's been interesting. So always have a look at the dollar index, especially if you're trading FX. Weekly chart, it's the weekly chart. Price was in that great uptrend. Okay, bear trap at 100. We had bear trap at 100. Great trend up. Double top. Okay, also had a bearish engulfing candle, a bearish key reversal candle. That was the end of that trend, and we can see price traded low down there. We had last week. The start of last week, we printed a rejection candle here off the 50, which turned into, that's a weekly morning star there, okay? And if we go into the daily chart, you can see that that's what happened at the end of last month, okay? We've just come off now. The dominant trend is still to the downside, but, there's already, a little bit of pressure there. I'll be, just looking to see how we kind of trade and break through that level. I'll be looking really, that's about 104.10. So kind of 104.10. My view is actually, I think this might be quiet-ish because we've got, of course, CPI tomorrow and FOMC on Wednesday. So we might have just a little bit of shenanigans as major players position themselves. But other than that, I think we'll be waiting to see what comes out of that news. So if I look at that today, it's the 30-minute chart now. That European session. It's just quite quiet. Okay, you can see on Friday morning European session the dollar index was quiet. No surprise because we were going into NFP. You can see all the volatility that NFP brought to the dollar index, and I think we'll probably continue a little bit of quieter session. Just because, as I said, I think we'll be waiting for the CPI and the FOMC data to come out, and that will be what provides any kind of catalyst for a big move, if at all. We will have to, like everybody else, we have to wait and see. If I look at the 5-minute chart, and the green box is basically, it's just an indicator, just gives me starts of sessions, and it's not. It's just pivoting around that 104.10 level. Okay, nothing there really terribly exciting there. If you look at how people are going to trade that, when you're looking at euro dollar is doing the opposite of the dollar index. Okay, on the daily chart. If I look at the daily chart, I see that as you've got the 200 period moving average above and the 50 period sloping up beneath it, and I think price will just coil up there until, because as I said, we've got US CPI Tuesday, US FOMC Wednesday night, and then we've got ECB on Thursday. So I think personally, it's just probably price. This is the 4-hour chart. Having had a week of a great run down, I wonder if we just basically coil up for a day or so until the news starts to give us an indication of what the future is with that. I think that's what I'll be looking at. Okay, I'll just be keeping my powder dry and waiting for the good trading opportunities that come out off the back of those after those major news announcements. So there you go, ladies and gentlemen. As I always say, time flies when you're having fun. Thank you very much for joining us today. I hope you have found today's session useful. There's stuff you can take away there and sort of just have a little bit of a look, do a little bit of research into utilising that for yourself. And and I hope that you will join us next Monday. Okay, next Monday is the last one of 2023. We'll talk about your trading plan for next year. So be sure to join us there. And until such time, have yourself a fabulous trading week, ladies and gentlemen. And I look forward to speaking to you soon. All right. Thanks, Brandon. Thanks, Chand. Thanks, everyone. Cheers. Bye-bye.